Hello, my name is Noah Bastido, and my presentation is on monetary policy throughout times of economic crisis. Now, oftentimes, historical events are defined not exactly by what preceded them, but rather how those in power responded to them. And this is a fact that remains true for even economic crises. Central banks such as the Fed and the ECB must be prepared to face whatever problems are thrown their way, because a lot of how the crisis turns out, such as how long it lasts and how the economy recovers, is mainly reliant upon them. A lot of information can actually be revealed by examining how central banks have responded to these crises in the past with monetary policy and the other tools at their disposal. One of the earliest tests for the Federal Reserve from an economic crisis standpoint was the Great Inflation. The Great Inflation was a financial crisis that lasted from the mid-1960s to about the mid-1980s, and in which inflation spiraled out of control and remained at an elevated level for the entire crisis. The Great Inflation was brought about for several reasons, the first of which being that prior to the crisis, the US government and the Federal Reserve favored keeping unemployment as low as possible, and as a result, they were willing to let inflation rise, as their Keynesian line of thought told them that when inflation is at a higher level, unemployment is actually able to reach lower levels. However, this line of thought forgets several factors, because as history has shown us, when people begin to suspect inflation, their spending habits change and the inflation only grows further as a result. Furthermore, completely disregarding inflation in favor of unemployment leaves inflation very prone to unexpected drops in production. And unfortunately for the United States, this is exactly what would occur as two separate energy crises arose. In October of 1973, the Organization of Arab Petroleum Exporting Countries placed an oil embargo on the United States, which tripled the price of oil, one of the most important factors of production within the United States. And naturally, production in the US fell to a grinding halt. This is when the US economy entered into a dreaded state known as stagflation. Stagflation is particularly dangerous as while inflation rises, the unemployment rate rises right along with it, and economic growth simultaneously falls, which goes against everything that economists had believed up until this point. As stagflation decimated the US economy, the Federal Reserve, headed by Chairman Arthur Burns at the time, desperately searched for an answer, but none of the traditional means of correcting unemployment would work. The Fed attempted to rein in unemployment by increasing the money supply, but this only made matters worse as it did nothing to control unemployment and only sent inflation skyrocketing further than it was before. No matter how hard the Fed searched, they could not find a solution to this stagflation that was ailing the country. That is, until Paul Volcker was named Fed chairman in August of 1979. Knowing that the only solution to the stagflation was some short-term economic pain, Paul Volcker raised interest rates to an unprecedented 20% to solve the issue. His harsh tactics even put the US into two separate recessions. Other politicians had feared the public backlash these moves would garner them, so they were too scared to make these moves on their own. The question that always arises with Paul Volcker's tactics was if the ends justified the means. And if you look at the empirical data, I believe that it clearly does. After Volcker raised interest rates, inflation plummeted from 15% to only 5% in 1 year. And perhaps even more telling is the fact that inflation has barely ever reached 5% again since the Great Inflation. Thus, inflation was no longer an issue within the US, and Paul Volcker is who we have to thank for this. The next major crisis which the Fed would have to overcome was the financial crisis of 2008 to 2009. Now, this crisis came about for a variety of reasons. Low interest rates and loosening of restrictions for banks in the early 2000s and the late 1990s pushed investors towards collateralized debt obligations, also known as CDOs. CDOs are a financial product that's made up of a pool of bank assets such as mortgages and other loans. The most favored type of CDOs to investors are mortgage-backed securities, which are CDOs but just mainly filled with mortgages. Banks enjoyed mortgage-backed securities because it allowed them to transfer the risk from these mortgages to other investors for an immediate return, while investors favored mortgage-backed securities because the housing market was known to be stable and was seen as an extremely safe investment. And generally, mortgage-backed securities were a safe investment. That is until banks started to get greedy and began filling these mortgage-backed securities with subprime mortgages. For those of you that don't know, subprime mortgages are when the bank gives out a loan to a borrower who has either a poor credit history or no credit history at all. So essentially, knowing that they could turn over these mortgages to mortgage-backed securities and get a return off them immediately, banks were willing to give a mortgage to anybody who walked in their doors. Unfortunately, when interest rates rose back up naturally from their low rates they had been in the early 2000s, subprime borrowers could no longer afford these mortgages they had taken out. And as a result, defaults began occurring en masse, and investors, seeing these defaults, completely pulled out of mortgage-backed securities, leaving banks with these worthless subprime mortgages on the books, which would cost them millions, as these subprime mortgages slowly eroded the balance sheets of these financial institutions. Seeing the trouble in the housing market, the Fed responded almost immediately with the tools that they have at their disposal. The Fed lowered the Fed funds rate to hopefully spur the economy to withstand the losses incurred in the housing market, and they started purchasing bonds with open market operations to put more money into the money supply. The Fed then began purchasing mortgage-backed securities from these banks that had them on their balance sheets as a part of the Troubled Asset Relief Program, in hopes of giving these banks some sort of return for these assets and stopping them from falling to insolvency. The Fed even deemed the situation so dire that they began developing some new tools to help them manipulate the economy. The first tool they established was the interest on reserves rate. The Fed would now pay banks for holding more reserves than what was required of them, and this actually gave banks an incentive to hold these reserves instead of lending them out as they normally would, since lending them out would garner them extra funds. Having extra reserves on hand helps these banks sustain any shocks to the economy that they aren't prepared for, and would have helped many more banks stay liquid had they been holding these reserves in the first place when the financial crisis came around. The second tool that the Fed established was the Primary Dealer Credit Facility, which was actually the first lending facility to non-depository institutions since the Great Depression. This helped save investment banks who don't hold deposits but were in need of loans from the Federal Reserve to save themselves from bankruptcy. Once again, the statistics help us show whether the Federal Reserve was successful or not in their response. And these statistics seem to show that it was a success. Bank failures quickly decreased after 2010 and had even reached zero as recent as 2018. What's more, these bank failures have stayed at a low total even during another economic crisis that was brought on by the coronavirus pandemic. Another statistic that proves the success of the Federal Reserve is GDP, and GDP quickly rebounded from negative growth in 2009 to positive growth in just 1 year later in 2010 because of the actions of the Fed. All in all, this financial crisis has taught the Fed several important lessons, the first being to be wary of asset bubbles. The Fed needs to monitor them correctly or else they can burst and bring the economy crashing down as the housing market did. The next thing that can be gleaned from this crisis is that the Fed needs to ensure that banks are not holding too few reserves. Many banks struggled throughout this financial crisis and would have done a lot better if they had adequate reserves to withstand the shock provided by this crisis. Finally, the Fed learned that access to credit for all institutions is extremely important during times of crisis, as during this crisis, many non-financial institutions struggled, as banks refused to hand out loans due to their own struggles. Now, the next major financial crisis, which required some sort of monetary policy to correct it, was one that I'm sure is fresh on all of your brains, as it's one we're still going through right now. It's the coronavirus epidemic, and first we're going to be talking about specifically the epidemic in the US. Now, this is a worldwide pandemic, as I'm sure you're all aware of, and the economy was one of the many areas of the world that was impacted by this pandemic, as pretty early on, stay-at-home orders were put in place throughout the entirety of the United States, forcing people to stay in their homes and quarantine away from others. Now, naturally, this makes it hard for businesses to conduct their operations as per usual, so many of them were forced to completely close down as a result of the coronavirus pandemic. And we saw the unemployment rate shoot up from 4.4% to 14.8% in just 1 month. A jump like this was naturally concerning to the Federal Reserve, so they took quick action and used monetary policy to their advantage. They started by lowering interest rates at an emergency meeting on March 3rd, which was right after the start of the pandemic. Then they went on to purchase $500 billion of Treasury securities and $200 billion of mortgage-backed securities from the public, taking a page out of the handbook from how they solved the financial crisis of 2008 to 2009. Next up, they vastly expanded their repurchase agreement operations, with the goal in mind of funneling more money into the economy to offset this sudden lack of production. Finally, the Federal Reserve created several new lending facilities in which businesses from almost any industry in the US could get direct loans from the Federal Reserve to ensure that they would stay liquid during this difficult time. The question of whether these monetary policy actions were successful or not is one that really can't be answered at this point in time, as we are still currently living through the coronavirus pandemic. There's arguments for and against what the Fed did, and both sides have their points. The detractors say that the actions that the Fed took to bail out these companies that were struggling as a result of the pandemic reinforces risky behavior within these businesses, and this could potentially lead to more crises in the future. While on the other side, supporters say that COVID was really a unique circumstance, as a worldwide pandemic is really not something that happens that often, and it really won't influence future behaviors of companies since they know that it was a special circumstance. On top of this, GDP has quickly rebounded since the pandemic began, having only really 1 quarter of extremely poor performance since the pandemic began, which is largely as a result of the Federal Reserve's actions. Now, sticking with the same crisis and just jumping to a different location, we're going to examine how the coronavirus crisis affected Europe. Naturally, there are a lot of similarities between the two, as unemployment jumped immensely in Europe also due to the stay-at-home order, and this caused economic production overall to grind to a halt. The differences start to come in the central banks that oversaw them. The European Central Bank oversaw the monetary policy during this specific part of the crisis. The ECB, like the Federal Reserve, took very decisive actions in the realm of monetary policy. First, they established the Pandemic Emergency Purchase Program, which is a program that purchased billions of dollars worth of debt assets from the public to get these debt assets off the balance sheets of institutions that were more prone to this financial crisis that they were entering. Next, they kept key interest rates historically low, as they were already low going in, but they made sure to keep those rates low to not put any unneeded pressure on the public. After that, they expanded the list of assets they'll accept as collateral for loans. Since they normally kept a strict guideline of what they would accept as collateral, they expanded those terms so more businesses would have access to loans than ever before. And finally, they set liquidity requirements to prevent insolvency among banks. There was another huge action that the ECB took during this crisis. They established currency swap lines. Now, the US dollar is almost exclusively used in cases of international trade, and it's also seen as a stable currency for many nations to have as a safe haven to fall back on if their currency starts to struggle. The ECB established swap lines with the Federal Reserve and other central banks around the world to ensure that they would have easy access to the US dollar during this time of crisis to then distribute these US dollars to any banks within the Eurozone. Once again, this is a crisis that is still raging on, so it's impossible to say whether the ECB's actions were successful or not. Supporters of the actions of the ECB say that the ECB's swift maneuvers actually prevented the economy from entering in a bigger crisis. This is evident to them as the ECB moved much quicker than they did during the financial crisis of 2008 to 2009, and they almost immediately started buying debt assets from the public. Detractors in this situation say that the ECB may have went too far and actually took some steps in the wrong directions. The Fed placed restrictions on banks that prevented them from paying out dividends to their stockholders in order to help them remain liquid. Now, detractors say that this created a huge problem as it made stockholders turn away from these banks in favor of other institutions that could still pay dividends and likely caused these banks to lose capital. Thank you for listening. Monetary policy impacted all of these situations immensely, so it's important to understand what exact actions were taken and what their results were.